down, very bottom.
Yeah. Hello everyone, welcome. Isn't that a nice picture, guys? All the startups here dream about that day. So we're gonna sort of hear from Renaud firsthand how to build a great company, and quite frankly, is our first company out of plug and play that went all the way to IPO. Congratulations, Renaud. You know, we have our partners here from Citibank, from Deutsche Bank, and Capital One, and we feel sort of Silicon Valley is a focus point of innovation in any industry. Either companies sort of like Lending Club can come and challenge the old status quo and build a great company, or even the banks can have sort of incremental improvement in digital, in mobile, and everything. But we just hope that the plug and play financial technology and security division can be a meetup place for everybody to come, to meet, and to sort of take innovation from that. Just to give you a little update, like in the last 6 months, we have had a great success with Lending Club going public. And then, but we had some other success stories. I don't know, Renaud, if you know number 26, but it is a small bank in Germany that is mobile only. So everything they do is on mobile. And Peter Thiel just put $10 million in the company after 18 months from the day it started. And we have, you know, Credit Sesame, Camcor, and for some of the brands and retailers, I don't know how many of you know NatureBox, but NatureBox is a company that is less than 4 years old. I think their top line is $400 million, and they deliver a healthy food every 2 weeks on subscription to mostly ladies in Midwest. Seriously, you know, because apparently in California we have Whole Foods and we have some places you could buy healthy stuff, and apparently in Midwest they don't have Whole Food. Am I correct or am I wrong? That's what I heard anyway. But what NatureBox really invented is the business model that they don't advertise. The only thing they do is online customer acquisition and delivery, and it's extremely profitable with 70% margins. And you know, having them raise, I think the 30 million they raised at about $350 million valuation. So these are some of our other success stories, and we had 26 other companies raise money for a total of about $150 million. Can you all read the Chinese? No. But I'm really excited to say that we are opening 2 plug and plays in China, and by the end of this year we will go to 5. And we really would love to make a sort of bridge between China and Silicon Valley. And the companies that are up here, I get a really interesting, China Mobile is like 2 times bigger than all telcos in the US combined. They have 800 million subscribers, and it is incredible how much more advanced they are than AT&T. If I remember, I'm not joking, this is not, I don't think they are in the room. No, but you know, we sort of have another retailer, Hisap. He came here on his way back from New York, and he said, you know, I was in New York buying a retailer, Brookstone, and we thought we did a little research on him before he arrived, And the research was like about a year or two old. So we thought he has 1,600 stores. When he arrived here, he said we have 4,000 stores. So it is incredible the economic growth that China is going through. And we really think bridging between Silicon Valley and China would be great for Chinese entrepreneurs, as well as entrepreneurs here that want to go to China. I know there is a lending club look-alike in China, so I hope they be really successful. This was announced. I mean, if you see this, we were one of the most active investors, except we write small check, like Sequoia writes $25 million checks, we write $25,000 checks. But nevertheless, it's good to be on top of any list. So with that, we are super, super excited about our FinTech activity, and I will ask Scott to come and tell you a little bit more what we are doing here. He does a much better job than I do.
Thank you, Saeed. Thank you, Saeed. I hope you all enjoyed the morning portion of content. Special thanks to Debbie from Citi and Ratnakar from Qualls. Today really represents about a year and a half of work in this space. It's really exciting for me. So again, I'm Scott Robinson. I'm the founder and director of the FinTech and Security program here at Plug and Play. We've been witnessing a massive trend in this space. In the past year, all capital deployed into the FinTech space has gone from $4 billion to $12 billion. We've seen roughly 30 different banks set up labs, shops, venture units right here down the street. And I think there's three major doomsday scenarios we're witnessing when you look at any financial entity. So first, some of you may have heard this, but many different startups are taking portions of business lines traditionally associated with banks, payment processors, and of course these are companies like Venmo, Square, Stripe, even Snapchat with Snapcash. So the big doomsday scenario we're seeing here is death by 1,000 cuts. PwC recently actually put out a report saying by the 2025, most traditional retail banking environments will be entirely different. And as we look at companies like Number 26 go entirely mobile, we expect the same across the board. Secondly, as the millennial demographic continues to become the largest group that will be subscribing to this mobile trend, we see these financial entities say, I have to find a way to avoid what is continuing to be a problem for us, because this millennial demographic is not loyal. Actually, they would prefer PayPal or Apple or Google. So we're watching an entire horizontal movement from major companies like Apple and PayPal, and of course you've seen Apple Pay. We'll see Loop Pay eventually. It's a huge market, and so for us, we're very excited about this. And lastly, with this mobile trend, there's a lot of problems for banks, and traditionally they're a slow-moving entity. They're not very good at iterating new technology. And as one of our mentors said, you can teach engineers finance, but you can't teach finance people technology. And so for us, we see this as a huge opportunity here in the Valley. So we're very proud to be partnering with Citibank, Capital One, USAA, Deutsche Bank, partners like Banco Original, Intuit, JCB, Assurant, and many more to come. So today represents 29 companies having gone through our 3-month program. And with that, the ultimate story for us, of course, is to have somebody like Renaud come back. So please help me in welcoming Renaud from Lending Club.
Hi, everybody. Thank you. So it's really good to be back here. So Lending Club started here at Plug and Play in Sunnyvale from 2007 to 2009. So it was a really good memories. Of course, it's the bottom one. All right, I'll just talk. Yeah. Okay. All right. So yeah, let's get started. So first, it's one of the things you have to go through when you're a public company. There's going to be a few pages of disclaimers. So this is actually a speed reading exercise. So you have 5 seconds to read disclaimers, and that's it. All right. So I thought I'd start by sort of talking a little bit about the early days, and really what gave me the idea of Lending Club back in 2006. I was at home and I was on vacation, so I probably had too much time on my hands, and I decided to read a credit card statement and realized that if I was going to carry over the balance to the next month, I would be paying sort of over 18% interest rate on my credit card. And then the next piece of mail I opened was my savings account statement, where I was earning sort of 0.5% interest rate. And the two statements were coming from the same bank. So that felt like a very big spread between these two interest rates. And just out of curiosity, I started to dig a little deeper to just understand where that spread was coming from. And what became pretty quickly apparent was that a lot of the spread goes into funding the high cost of operations of the banks and the cost of collecting deposits on one side and turning around and making loans, and the thousands of branches and tens of thousands of employees that go into that process. And so the very basic idea of Lending Club was, okay, would there be a more cost-efficient mechanism to allocate capital from the depositors on one side, the source of capital, to the borrowers, to the use of capital on the other side. And so that's really how Lending Club got started, and that's still what Lending Club is today, which is a marketplace where sort of investors provide the capital, take the credit risk on the loans, and borrowers sort of obtain loans, make monthly payments, and Lending Club in the middle essentially underwrites prices and services the loans. And so there are a few sort of benefits in operating as a marketplace, but the number one benefit clearly is the one we intended to deliver as part of this initial idea of operating at a lower cost than the traditional banks. So it was just an idea 8 years ago. It's now we have a lot of data to back it up and say we are operating at a lower cost than the traditional banks. The typical sort of ratio, the operating expense ratio at a bank is between 5 and 7%. The operating ratio for Lending Club, assuming no growth in the portfolio, would be about 2% and coming down every quarter as we gain scale and continue to automate tasks that are manual for the banks. So there are a number of sources of cost reduction. There are costs that we don't incur at all, like the cost of maintaining a branch network or the cost of insuring deposits that we don't have. So no reserve requirements, no FDIC insurance. And then there are costs that we do incur of acquiring customers and underwriting loans and servicing loans, but that's where we use technology to automate processes and lower this cost. And so what we can achieve by doing so is pretty massive sort of value creation, where if you compare to a case where sort of a bank pays sort of less than 0.1% on deposits, and on average charges over 21% interest rate on credit cards, including fees. We get to a situation with Lending Club where, by operating at a lower cost, we can give a considerably better deal to both sides and offer a much better return to investors, who are in this case also taking the risk on the loans, with a 8.5% of average return after credit losses and after fees over the last several years, and also a much lower interest rate to borrowers who benefit from significant savings compared to the rates they're paying on credit cards. So because we deliver so much value to both sides, we've been able to grow pretty quickly over the last sort of several years to the point where in the last quarter we've enabled about $1.6 billion in loans. So the numbers are getting bigger, but what's really exciting is we're not even growing. we're not even growing as fast as we could. We're growing as fast as we believe is responsible and sustainable. And that's why you see almost a straight line in terms of loan origination growth. It's really because we're not growing as fast as possible. We're calibrating the growth, we're controlling the growth, and sort of delivering a very consistent growth to investors. So a couple of sort of interesting data points I wanted to share with you on the investor and the borrower side before we chat with Said. So on the investor side, back in sort of 2000, on the borrower side, back in 2009, we were really appealing to early adopters, mostly the millennial generation, and we had 50% of our users who were sort of less than 35-year-old. Today, we've become a lot more mainstream. Our population is really a representation of the US population, and the millennials are only representing 25% of the sort of our customer base. Then another sort of really interesting data point that I believe comes from the technology, sort of technology-enabled characteristics of the marketplace. The technology, we use technology in two ways, or for two purposes. One is to lower cost, the other is to deliver a better experience. So the better experience is essentially evidenced by the Net Promoter Score, which measures our customers' willingness to recommend our products to their friends and colleagues. And that Net Promoter Score has been in the 70s, so high 70s, pretty much since we started measuring it. And it offers a stark contrast with the rest of the banking industry that historically hasn't been doing a great job at delighting their customers. And so the average in the banking industry is in the 20s, with credit unions and community banks doing generally a better job, but the large national banks sort of being in the single digit, so essentially being net detractors and generating sort of more negative buzz as their customer base grow. So I think one of the closing thoughts I had was really talking about the network effect. I think that the marketplace really benefits from a lot of positive, self-reinforcing mechanisms that make it better as it gets bigger. So as we gain a longer track record, we see investors being willing to accept a lower return on their investments because we've increased the certainty or the likelihood of the return. And as we accept a lower return, we're able to lower the interest rate on the borrower side. And with lower interest rates, we generate better marketing efficiency for ourselves, but we also generate better credit quality with positive selection on the borrower side, which helps reinforce the good track record of performance, which in turn contributes to reinforcing the positive circle and give more confidence to investors. So that network effect is very different from what happens typically in a bank, where the two sides of the equation, the lending side and the borrowing side, are disconnected. And so it's working fairly well. So we've increased our ambition, which is now to transform the entire banking system and really make credit more affordable for consumers, make investing more rewarding for investors. And we believe that over time, we can transform the entire banking system and offer the entire range of credit products to consumers and businesses, and truly make the banking system the way it should be, more transparent, more cost efficient, and more consumer friendly, with the interest of the consumers coming first. Thank you.
So with the risk of having a lot of bankers in the room, do you think the banks, the way we have them today, will exist 20 years from now?
So I think banking is going to look very, very differently from even 10 years from now than it does today. I think the banks will still exist. I think many of the banks will be very successful. So as far as credit is concerned, our vision of transforming the banking system is not necessarily in competition with the banks. We actually believe that the banks can benefit from that transformation and become participants on the marketplace. And we've already started that process. We announced recently a partnership with Bank Alliance, which is a network of 200 community banks that sort of combined would be the fourth largest bank in the country by number of branches. These community banks essentially now make loans to their customers through the Lending Club platform. And that way it's of benefit from our platform that gives them a new product, which is a very responsible and affordable product to give to their customers, and another way for the banks to put their deposit to work. So I think we can really craft the transformation of the banking system in a way that benefits the banks, benefit us, and really benefit the customers. If you think of the cost of credit as the addition of the cost of operations and the cost of capital, Lending Club has the lowest possible cost of operation by operating fully online in a highly automated way. And the banks have a very low cost of capital. So the combination of these two can help lower the cost of credit for consumers and businesses.
So I think that's a great announcement you made. And I recall something similar like about 10, 15 years ago, when Google first powered search for Yahoo and AOL before really taking their business. Do you think this is like a first step in you taking over the banks, and it's sort of first powered by Lending Club, and then this is not the, I mean, like, frankly speaking, if your cost is lower, what do they have other than the customer relationship that they are offering that cannot be their business totally interrupted?
Yeah, so I think
this is controversial and not easy questions I ask him.
I asked Say to send me the questions in advance, but he didn't, so it's a good surprise. No, so I think that it's one of two potential outcomes. I mean, it's possible that the business of the banks slowly dwindle. Another real possibility that the banks really embrace that transformation and sort of refocus their business on the things they're good at. And so, for example, we have no intent of ever taking deposits. Making an investment in loans is just one part of your overall sort of asset allocation. There's another portion of your assets that's going to be in cash, and that should be sitting in deposits, and deposits should be FDIC insured. And so the banks are the perfect sort of mechanism to achieve that.
That is fantastic. You know, many businesses, before you joining us, we were talking about retail, how that the e-commerce has really put a dent in some of the retailers, and now they are becoming much more interested to transform themselves. Do you think, like, if the banks really work hard in mobile, digital, and transforming themselves, they can, grow? Or do you think, like, all the banks can grow, or some of them will disappear?
So I think the best possible strategy for the banks at this point in terms of credit is, again, to benefit from the marketplace. I think the strategy of trying to create their own marketplace is a much sort of harder and adventurous path. There's part of what is needed to create a sort of online marketplace from scratch is a very low cost of operations and a sort of technology DNA, which the banks don't necessarily have. I mean, the IT departments of the banks are generally busy sort of integrating disparate IT systems coming from mergers of several banks over the last several years. They're not necessarily as nimble. They don't necessarily have the mindset you have in Silicon Valley of solving problems with technology. And sometimes the bank's technology is a problem.
You're so much on the point. In fact, we feel exactly the same way that, technology can solve a lot of problems, but they really also, we were talking in the patio, they have to serve their 60 million clients in 5 different continents, and to move that ship is not very easy. Sometimes it's easier. Let me go back, because we have a lot of entrepreneurs in the room. Go entrepreneurs, yeah? I was wondering, what was the most interesting moments or interesting events in your first 2 years in Lending Club, both exciting as well as challenging?
Other than meeting you?
I'm glad he's not asking the questions, or else I would be fried. Yeah.
Well, yet I haven't told you if it was exciting or challenging. Actually, truly a turning point in Lending Club and in the way we think about the business was actually at Plug and Play when we first met with the folks who were working on the Facebook platform at the time. So back in 2007, the Facebook platform called F8, the code name at the time, was just getting into place. And through a Plug and Play event, we met with the folks at Facebook and decided to launch Lending Club as a Facebook application. And I think that's one of the first really big PR events that put us on the map. Facebook at the time was interested in diversifying outside of their college graduates or college population and becoming more mainstream, and was interested in featuring an app that would be doing something else than games or typical MySpace apps at the time. And they're also very interested in featuring Lending Club as an application. So we did 5 case studies on the 5 most promising apps. Lending Club was one of them. So that got us a lot of press. I think that contributed to raising our Series A round. That contributed to us hiring a number of the executives we hired at the time, and really positioned us as a true native social and technology company, and not as a financial company.
Wonderful. And I know that you know Jeff Crow, my friend, really well. When you look for an investor, what because I know you do everything very diligently, what do you look for in your early investor, later on investor? What characteristics you're trying to have in your investors if you have a choice?
Yeah, so I think I focus more on the person who would be sitting on the board than on the firm itself. So in the case of Norwest and Jeff Crow, that was the perfect match, because Norwest is the venture arm of Wells Fargo. So the connection with Wells Fargo was very useful to us. It was the beginning of our partnerships with banks. But Jeff, in particular, had a lot of experience building companies, being the head of operations at several companies that went through the process of going from a few employees or a few tens of employees to hundreds of employees, with all the issues that happened at the time, and having been there before and having a roadmap or at least a framework for going through that phase of growth and keeping it together was super helpful. Dan Ciporin, who was another early board member of Lending Club, also had a lot of experience from MasterCard and then from shopping.com. So really the credit and debit side of things and the online customer acquisitions. So the early board members really had the type of experience we needed in products and in human resources and operations and process management. So that was really helpful, I think more helpful than what the firm was, but it was about the person who would come on the board.
Thank you so much, because sometimes I have a startup come for raising funds, and they kind of ask these days, like, how do you invest, or what else you have invested in? Because I know that a good entrepreneur should know everything about the person he's going to meet or she's going to meet before the meeting starts. Am I correct on that? And I believe the entrepreneur has to be the most knowledgeable person in the room about the business model you were trying to create and execute on. Am I correct on that? I mean, what advice do you have for some of the entrepreneurs in the room?
You know, I mean, clearly the way so the early investors and the VCs are going to make a decision is really, I mean, partially based on the idea and partially based on the early execution, the prototype or the MVP, but really mostly based on you as an entrepreneur and how much we believe in you. So making sure you know everything you need to know before the meeting is clearly a great advice. Everything you need to know about the person you're talking to, but more importantly, everything you need to know about your product, about your market, about past experiences. And remember that investors and VCs in particular have a big deal flow. They see tens of deals every day. And they typically sort of know a lot. They've been around the block. They've seen sort of startups similar to yours succeed or fail. So it's really important to be on the same sort of level of knowledge of what has worked in the past, what has been tried, what hasn't worked, why it hasn't worked, and really where you fit into that sort of progression.
Wonderful. Renaud, on a personal note, running a publicly traded company, do you think you're working harder now or in the early days as an entrepreneur when you were juggling raising money, juggling, hiring people, convincing people?
Yeah, so it's interesting. It's about the same. So I keep,
it's only 80 hours a week.
Yeah, exactly. I keep telling my wife, let's do this next month. It's going to be a lot less busy. It's been 8 years that way. And certainly the job has changed a lot. So what I'm busy with is very different. It went from very sort of basic things in terms of foundational things, sort of working on product and building the team, to now sort of, I think, worrying a little bit less about day-to-day operations and more about sort of longer-term strategy. Spending a bit more time with investors and analysts, but more generally on sort of communications. And I think when you become a bigger company, there are less opportunities to influence people one-on-one. And so it becomes more of a sort of broadcasting of the message. But the good news is you have a lot more sort of opportunities to broadcast the message. And so having a really sort of thoughtful plan to deliver the message and the story becomes really important. And then when things start going well, I think unfortunately you end up spending more time playing defense than offense, because you start thinking about, okay, what can go wrong from there, and start spending more time on controls, processes, compliance, so anything, security, anything that can really sort of break the machine.
Thank you so much. You know, one of my joint venture partners is Axel Springer, which is a print publishing company that, like, roughly 10 years ago, they were at the verge of bankruptcy, and then they transformed themselves, and they are now incredibly profitable, growing really fast, embracing the digital movement rather than fighting it. And still they run their print business very profitable, but it's as a declining thing. If you had a word of advice for the old financial institutions, by old I don't mean I'm getting old, so I don't mind, the ones that are structured like in the past, what advice you would have? And also I would love you to close with what advice do you have for our entrepreneurs? Like a couple of bullet points.
All right. So
I'm picking on the banks, huh? I'm sorry.
Well, I think that most of the banks are doing the right thing, considering the situation they're in, and they're sort of genuinely curious and interested about innovation and trying to figure out what the best way is for them to transform their business and make sure they continue to stay in touch with their customers, understanding that their customers' habits and expectations are changing very quickly as new technology develops and as new technology-enabled players enter the market. And it seems to me that an alliance with technology-enabled players is really the best route. So in the case of credit, again, Lending Club and the banks can play to each other's strength for the greater benefit of customers. We can offer a lower cost of operations, the cost can offer a lower cost of capital, and a large customer base. So I think there are many ways for incumbents to partner with technology players rather than trying to compete, which again is a very sort of hard and adventurous strategy.
And to the startups?
Yeah, well, so I guess the number one sort of advice I got when I was at that stage and I give now is really to focus on the team, on building a great team. Because at some point everything is going to be the outcome of how, the value of a company is just the sum value for the people who work there. And when, especially the early employees are critical because they're going to be the ones who hire the next level down and hire the next level down. And there's a lot of pressure in the early days, especially when you just raise money and you have sort of this big plan to grow really fast. There's a lot of pressure to just hire people and get a butt in the seat and get going. But really not compromising on talent, not compromising also on the fit between the person you're hiring and your vision or your culture and where you're trying to go is eventually what's going to dictate a lot of the success, of the future success of the company.
Really, I agree with you 100%, and thank you so much for coming here and celebrating with us our first IPO. Thank you.
And with that, there's a lot of work that goes into the FinTech program, so there's a large team that we have, and so without George, I don't know where we'd be, and the ventures team, Yvonne and Emiko, but we'd like to kick off the second half today, so you'll be taking in about 22 FinTech and security startups, and please help me in welcoming George Demiri from our ventures team.
Thanks again, Scott. Ooh, this is loud. Can you all hear me? So, yeah, as Scott mentioned, we did, this is our first official batch of our FinTech Accelerator program, launched with, of course, our excellent banking partners, as you can see along the walls. So we did screen about 864 startups for this program, and with the help of our corporate partners, they helped us choose 29 to accept, invest, and accelerate in this 3-month program. So you'll see about 23 of those today. So first up, I want to introduce BehavioSec, an awesome behavioral biometrics company. Please welcome Olav.
Thanks. First pitch after the lunch break. So my name is Olof. I'm the co-founder and CEO